Hello, I'm Noel Lim on ASEAN Speaks by Maybank Investment Banking Group. Concerns over slowing US economic growth, interest rate hikes and soaring inflation have dampened market sentiment. Cryptos were not spared too. Closer to home, Bank Negara Malaysia surprised the market by raising the overnight policy rate by 25 basis points. And in the Philippines, partial unofficial election results show Marcos Jr. is ahead with over 30 million votes, more than double that of his closest rival. Chua Hak, Regional Co-Head of Macro Research, speaks to our analysts as they unpack what the news means for stocks this week.
Hey, hi, morning. It's Tuesday, 17 May. Just a quick recap. Last week, markets suffered a heart attack with concerns over inflation, interest rate hikes, China lockdowns, the Ukraine-Russia war, and recession. Stocks did rebound last Friday to trim losses, but I think gave up some gains last night. The MSCI World Index fell about 2.2% last week. There's a sixth consecutive week of decline. Nasdaq fell 2.8%. ASEAN markets were not spared, with Singapore STI falling 3.1% for the week. The dollar DXY index rose 0.8% to a 20-year high, and the 10-year bond yield fell slightly over 20 bips last week on recession fears. But I think a real crash was in crypto and the USD stablecoins. The Bloomberg Galaxy Crypto Index fell 24% last week to the lowest level since early 2021. Terra and Luna, designed to be stablecoins, pegged 1-for-1 to the US dollar, but that peg broke apart last week, with Luna crashing by more than 99% to near zero. I think the crypto crash has shaken investor confidence and raised concerns over the risk to the financial system. Food protectionism is on the rise. More bad news for food prices after Indonesia's export ban on palm oil, as India banned wheat exports to tame domestic prices, as a scorching heat wave is hurting output. I think I saw the futures prices on wheat was up about 6% yesterday. India is the second world largest wheat producer. The largest importer of wheat from India includes in Bangladesh, but also several ASEAN countries, including Indonesia and the Philippines. China's April data was released yesterday and disappointed as lockdowns weigh on consumer spending and industrial production. Retail sales fell by 11.1% in April. Industrial production dropped 2.9%. Manufacturing fell by 4.6%, dragged down by a slump in auto and equipment. Fixed asset investments for the first 4 months rose by 6.8%, slightly missing expectations. Unemployment rate in the 31 largest cities climbed to a new high of 6.7%. On a more positive side, Shanghai aims to end all the lockdowns by 1st of June. The PBOC cut mortgage rates for the first time home buyers on Sunday, a targeted move and probably not enough to turn the property slump around. Yesterday, PBOC kept the lending rates unchanged. I think they're opting for more targeted measures. For the rest of this week, markets will be keeping track of Fed Chair Powell's speech at a Wall Street Journal conference and comments from other Fed officials. But it's looking increasingly likely that Fed will hike by another 50 basis points in the mid-June meeting. I think other US data this week include US retail sales, industrial production, New York Empire State manufacturing, and lots of housing data. At the end of the week, President Biden will be heading to North Asia for a 4-day trip to South Korea and Japan to attend a summit with Japan, India, and Australia. In Europe, markets will be focused on the Eurozone and UK April inflation data, the ECB meeting minutes, and ECB President Lagarde's speech. In ASEAN, the Philippine Central Bank will be meeting on Thursday to decide on interest rates. Will the BSP be the next ASEAN bank to hike after Bank Negara's surprise move? We'll have Dr. Zamros on the call later. Singapore reports export trade data on Friday. I think a handful of key Asian companies reporting earnings this week include JD.com, Sea, Tencent, Xiaomi. Today, we have Suhaimi on Bank Negara's surprise rate hike and Malaysia's first quarter GDP. Desmond on the implications of rate hike for bank earnings. Winson on the latest on bond markets and what he favors. Anand on ASEAN's equity strategy and how it's doing against the backdrop of crashing tech and crypto. Jacqui on the Philippines election results and what it means for the markets. Zamros on the Philippines stunning 1Q GDP growth and what the BSP will likely do this week. And Huy on the Vietnam markets and whether to buy after the markets has collapsed by more than 15% since mid-April. So let's kick off first with Suhaimi. I think Bank Negara surprised with a 25 basis point rate hike last week. What was the rationale for the hike and what are you expecting for the rest of this year and next year?
Good morning, Habin and everyone. The 25 basis point hike in OPR by Bank Negara last week to 2% reflect several factors in our opinion. These include rising momentum in domestic economic growth, on economic reopening. This is as per the pickup in first quarter 2022 real GDP growth to 5% from a growth of 3.6% in fourth quarter of last year and 3.1% growth the whole of last year. We also have the acceleration in core inflation, which rose to almost 3-year high of 2% in March and averaged 1.7% in first quarter of this year, compared with 0.7% core inflation rate in 2021. And there's also the situation where we believe Bank Negara is responding to the pressures on ringgit against dollar in particular, amid the narrowing positive carry as US Fed embarked on aggressive interest rate hike cycles. We now expect another 25 basis point hike later this year for a total of 50 basis point in 2022, to be followed by 75 basis point hikes next year. So this is a slight tweak from our previous outlook of 25 basis point hike this year and 100 basis point increases next year. Total amount of hikes in OPR in 2022-2023 remains 125 basis point to basically bring OPR back to the pre-COVID level of 3% by end of next year.
So Suhaimi, Malaysia first quarter GDP came in at 5%, I guess driven by the reopening. Is this within your expectations, and what are you projecting in terms of the trajectory for the second quarter and the rest of the year?
Yeah, the first quarter growth of 5%, not far off from our 5.3% estimate, and actually better than consensus estimate of 4%. Overall, we are sticking to our full year economic growth forecast of 6%. We see likelihood of stronger second quarter GDP growth, supported by further opening of the economy, especially with the lifting of international border restrictions on 1st of April to stimulate tourism and travel-related sectors and industries, plus the pent-up demand and spending, especially during the Ramadan and Eid in April and May, amid removals and relaxations of containment measures, and not to mention the boost to consumer spending from the fourth round of EPF withdrawal scheme that is totaling around 45 billion ringgit. But we do expect GDP growth to start moderating in second half of this year, as the economy is expected to be impacted by global headwinds from the prolonged Russia-Ukraine war, rolling lockdowns in China, and aggressive US Fed's monetary policy tightening, leading to the risk of inflation, interest rates, and growth hard landing, if not recession. And for Malaysia, a key policy factor is the earlier than expected OPR hikes mentioned earlier. And our sensitivity analysis is that a 25 basis point hike in OPR cuts real GDP growth by 0.2 percentage point over a period of 1 year from the hike, and the biggest impact occurring 3 to 4 quarters after the hike. Just to add also lastly, for next year GDP growth, we have trimmed it from 5% previously to 4.7%.
I think the balance of payments data was also released last week. Looks like the current account surplus is much smaller despite the high oil and gas and palm oil prices. And on the capital account, there seems to be a big increase in FDI. So what's driving some of these changes?
The current account surplus narrowed to 3 billion ringgit, or just 0.7% of GDP last quarter, compared with fourth quarter last year's surplus of 15 billion, or 3.6% of GDP. I think the main factor is the smaller surplus in goods trade account. It dropped to 40.5 billion ringgit in first Q, compared with 52 billion ringgit in fourth Q. And really that boils down to stronger domestic demand causing higher import growth relative to export growth. I mean, import growth still record a robust growth of 24% in first Q of this year, just slightly down from 26% year-on-year in fourth Q. And Q-on-Q it grew almost 5%. Whereas export growth slowed a bit more to 19% year-on-year from 25% in fourth Q, and Q-on-Q it actually dropped. Now, FDI flows into Malaysia have recovered since fourth quarter of 2020, and it's been gaining momentum as it benefit from the realization of earlier approved FDI that were disrupted by lockdowns and restrictions last couple of years. And to note, I think the outlook is positive given last year's 225% surge in total approved FDI that were driven mainly by approved manufacturing FDI, which tripled last year from 2020 level and accounted for nearly 90% of total approved FDI and dominated especially by E&Es.
Okay, thanks, Suhaimi. Let's bring in Desmond. So Desmond, with the Bank Negara rate hike, what's the impact on the Malaysian bank earnings and margins, and which banks will benefit most?
Good morning. So generally, rate hikes are short-term positive to banks' earnings, mainly because the variable lending rates tend to adjust automatically while there is a time lag in repricing your fixed deposits. So floating rate loans currently account for about 80% of total banking system loans, while fixed deposits generally account for about 60% of total deposits. The guidance from the banks typically points to a 2 to 3 basis points enhancement to margins for every 25 basis point rate hike. At the top end, key beneficiaries will be the likes of Alliance Bank, RHB, AMMB, and Public Bank, which we estimate could see an uplift in earnings of about 2.6% for every 25 basis points rate hike. Despite the expectations of rate hikes into 2023, however, I see no compulsion to raise banks' earnings just yet. An immediate concern would be the prospect of mark-to-market losses as a result of rising bond yields. For instance, the 10-year MGS now stands at about 4.3% versus 3.6% in December 2021. As such, I'm maintaining my forecast for now, as any improvement in margins would serve to buffer against such mark-to-market losses.
So Desmond, the ringgit has been weakening against the dollar. Has this historically mattered for bank earnings, margins, or NPLs?
Not really, because at the end of the day, a lot of the activities are quite domestic for the banks. A lot of the financing is for domestic activity itself, so I don't see a major impact from that.
Okay, thanks, Desmond. Let's bring in Winson. With more central banks now raising rates to fight inflation and keep out the Fed, what's happening to US, China, and ASEAN bond yields?
Hi, good morning, Habin. Bond yield has increased, and there's been a lot of hawkish repricing in global bonds. On a year-to-date basis, for example, the 10-year sovereign yields of the US and ASEAN are up by between 80 to 150 bips. And interestingly, if we look at the total amount of negative yielding debt globally, it has fallen from about 11 trillion at the beginning of the year to about 3 trillion currently. So within G4 and emerging Asia, most of the central banks have either started raising rates or expected to do so over the next few months. And even for, let's say, the negative rate regime like the Eurozone, the market has actually also priced in for the ECB rate to go above 0 before the end of the year. But of course, we have China, which is an exception. The PBOC might cut rate because of economic slowdown risk due to the COVID lockdown. And China government bond is probably the only government bond market with a positive return year to date. But I think the good news is if you look at the recent trend on, for example, the US Treasury market, the yield volatility seems to have stabilized recently. At least over the past 2 weeks, the 10-year yield hit a 3.2% high in early May, but it has since fallen by about 30 bp now at about 2.9%. I think, frankly, in this environment with unprecedented supply chain disruption, it's really hard to forecast confidently where inflation will be in the next 1 to 2 years. But in terms of bond pricing, I think it has priced in a lot of inflation upside risk. So I think US rates market and treasuries, they're overpricing inflation fear while underpricing US recession risk. And if we look at the US financial condition, actually have tightened. It's still accommodative, but it has tightened quite considerably on a year-to-date basis, and credit spreads, let's say the high yield US corporate, have widened quite a lot to the highest level since November 2020.
So Winston, which bonds and part of curve do you favor, and which country bonds now are you most bearish?
On the countries that we look at, we have a bullish bias. We are mildly bullish on both US Treasury and Singapore government bonds. We think the 10-year yields of these two countries will fall below 2.5% in the second half of the year when inflation fears start to ease and growth concerns increase further. But I have to say this is a non-consensus call. And within ASEAN, we like Malaysia government bonds. And the market has priced in almost a full normalization in OPR to above 3%. And if you look at the onshore ringgit IRS curve, the implied pricings. They actually expect the OPR to go almost 3%, not in 2023, but by the end of 2022. So I think that's too much. Investors are staring at record high yields with fear, which I think is typical in a bear market. So in short, we are bullish MGS, we are bullish durations, but I just want to highlight a caution on high yielder, for example, the Indonesia, because both the rupiah and Indo-GB have benefited quite a lot from Bank Indonesia policy support since the pandemic. For example, the purchase of government bond, direct debt monetization. So in a way, I think they are more exposed to policy exit risk when Bank Indonesia eventually reduce its participation in the bond market. And you also usually, if the US financial conditions tighten and credit spreads widen, it will affect the rates market and FX markets of high yielder more than the other markets.
Great, thanks, Winson. Let's bring in Anand. On your latest ASEAN strategy, what are the key themes and highlights? And is the crypto and tech sell-off spilling over to ASEAN markets as well?
Hi, good morning, Hak Bin and everyone out there. Yeah, that's an interesting question, whether we are seeing a spillover from the crypto market, which has really crashed. I mean, definitely, ASEAN had a very rough fortnight. You can see here that, in US dollar terms, even the ASEAN markets have given up all their gains. But I guess crypto does have some impact on sentiment, especially among the retailers. But there are more fundamental issues at play for ASEAN now, which are gaining more prominence. One is what Suhaimi alluded to, the growing concerns about a hard landing globally. And I think the data out of China yesterday for their April growth is really going to underscore that overhang or that concern for ASEAN markets going forward. And we will see downside pressure on GDP forecast this year. The other thing that spooked ASEAN markets, perhaps more than the crypto issue, is interest rates. So, the consensus view has always been that ASEAN would lag by about 8 to 12 months in terms of interest rate increases vis-a-vis the developed world. But that view is obviously changing with the rate hikes in India and in Malaysia. So sooner rate hikes would reinforce that expectation that we could see a GDP slowdown as early as the second half of this year, despite the reopening thematic.
So Anand, what are the key changes to the top buys and sells?
Yeah, I think, it sounds like a very bearish picture for ASEAN, but really, to quote our new Indonesian head of research, Jeff's title in his ASEAN Plus contribution this week, ASEAN remains the cleanest dirty shirt on a global and regional basis. And we continue to see good traction in earnings from the reopening thematic. So, we are seeing more upgrades and downgrades still as reopening earnings come through in first quarter 2022 results. And in this edition, we've upgraded particularly in Thailand in terms of the property sector. APTB has been raised to buy. Also Bangkok to sit, the healthcare space has been raised to buy, joining Bumrungrad in terms of medical tourism inflows from border reopening. And we've also initiated on new stocks like CVL SB in Singapore and Farm Fresh in Malaysia, also with buy ratings. So, we are seeing value. We are seeing earnings coming through, and especially in the tech sector, which has been a huge concern for so many people. The results have been coming through both in Singapore as well as in Malaysia. Overnight we had Inari as well, which really met expectations. So far, at least, earnings are holding together and meeting expectations. So, yeah. There's a lot of pressure, but there are bargains out there.
Thanks, Anand. Jacqui, elections. I think the final tally shows Ferdinand Marcos Jr. and running mate Sarah Duterte winning by a comfortable margin. Are you expecting any big change in terms of policy direction?
Hi, good morning, everybody. The short answer is no. We expect the Marcos administration to continue on Duterte's socioeconomic programs, which mainly focus on FDI creation by minimizing restrictions and improving ease of doing business in the Philippines, and micro, small, and medium enterprise support. The Duterte administration closed with a lot of relevant bills signed. Among the more important ones are the CREATE Act, which lowered corporate income taxes from 30% to 25%, and the Public Service Act, which enables foreigners to fully own public service assets like toll roads, telco companies, air transport, and shipping assets. Indirectly as well, we think that the constancy or the lack of too many administrative changes could actually be supportive of businesses in this early stage recovery period.
how are foreign investors actually reacting so far to the results? Are there concerns about return to populism and populist policies?
The win isn't necessarily a surprise, since even the first round of surveys from last year have shown Marcos leading by a large margin. However, we are sensing that investors are on a wait and see mode as they await the announcement of the composition of Marcos's cabinet members to somehow make a more refined reading of what economic programs will be in position accordingly. Currently, he has only announced or identified the heads of the Department of Education and the Department of Interior and Local Government, but has yet to name his Department of Finance secretary.
Okay, thanks, Jacqui.
Thank you.
Zamros, the Philippines first quarter GDP came in at a very strong 8.3%. So what's driving the strong rebound, and can this be sustained?
Hi, morning, Harbin. Morning, everyone. Yeah, the 8.3% growth in the first quarter is basically higher than consensus and higher than our own expectation. So the strong rebound of 8.3% basically contributed by the improved domestic demand, whereby domestic demand expanded at 10.3%, with double-digit growth in gross fixed capital formation and as well as private consumption, as the unemployment rate in Philippines improved from 6% in January and February to 5.4% in March. And also because of the gradual reopening of the economy, and as at April this year, about 79% of the economy is still at level 1, which is the least restricted of movement measures under COVID-19 pandemic.
So Zamro, what's your GDP forecast for this year and next? And I guess the BSP is meeting this week. Are you expecting a hike?
Yeah, we despite the 8.3% growth in the first quarter, we adjusted downward our growth this year from 7% to 6.5%, mainly because of the external headwinds coming from the elevated global commodity prices, the ongoing Russia-Ukraine war, China's economic slowdown, and the repercussions from the aggressive US interest rate hike. As far as BSP is concerned, we don't expect BSP to make a move this Thursday because we think the government will continue with the non-monetary measures, especially enhancing on the reducing further the import tariff for pork and rice. But I think with the inflation already breached the BSP's target range. In April, it was 4.9%. When we expect inflation to peak at around 5.5% in June or July this year, we expect BSP to make a first move next month in June by 25 basis points.
Thanks, Zamros. Let's bring in Huy, our Vietnam strategist. Huy, the Vietnam stock market has suddenly crashed by more than 15% since the middle of April. So what's driving this sharp correction? And are earnings results coming in above or below your expectations so far?
Good morning, Harbin. Well, it is due to a liquidity crunch. Well, in April, Vietnamese regulators decided to crack down on stock manipulation and scrutinize the corporate bond market. This legal action hit margin lending activities in the stock market, while investors' leverage is at the record high. As a result, a liquidity crunch occurred, making the broad market spiral down. However, we view this tumble is a purely liquidity issue. Policy-wise, Prime Minister said that the government wants to make the capital market more transparent and sustainable in the long term. Economy-wise, the stock market is decoupling from the current economic recovery, in our view, thanks to the country reopening. Domestic consumption has returned to pre-pandemic level if we look at the retail sales or air transportation demand. Meanwhile, listed companies post 28% year-over-year earnings growth in the first quarter of this year and target 28% growth for full years. This full year target and the result of the first quarter is above our expectation, which shows growing business confidence in the country. And actually, moreover, in comparison with the crackdown on the banking system back to 2012, 10 years ago, the current turmoil has a much smaller scope, while the banking system now is much healthier than 10 years ago. So therefore, we believe the economy will not derail from its recovery trajectory. And we still believe in the long-term growth of the Vietnam stock market.
So this client asked me, because I think he was trying to draw a parallel with China, and was wondering whether, what's happening in the regulatory crackdown in Vietnam. Should investors draw parallels with the China regulatory crackdown as well on corruption, puppy leverage, or this refocus towards common prosperity? Do you think that's a fair comparison or kind of misleading?
Well, not really. Well, there are similarities. If we talk about a crackdown on stock market, scrutiny in the corporate bond market, especially for real estate developers, and even a fine to local star singer for his improper movie content last month. But unlike China real estate market, Vietnam property sector is still undersupplied, and the gearing of developers are not too high in general. We believe so. And in the bigger picture, Vietnam is well positioned, and the government want to leverage all of its advantage to capture the ongoing reallocation of global supply chain away from China. So the government aims Vietnam to become a developed and high-income country by 2045. So I don't think it wants to dampen the long-term growth of the economy.
Okay, great. Thanks, Huy. That's all we have today. Have a good week ahead.
For specific advice, speak to your trading rep and check out market insights on the Maybank Trade app. Happy investing. This is Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group.